Good morning. We will pay attention to the inventory systems today, and we will determine what is the difference between the periodic inventory system and the perpetual inventory system. Because if the different systems are used, transactions are recorded differently, so it's very important to determine which method is used. If we record entries in the cash receipts journal, we don't have a cost of sales column in the cash receipts journal. So there's no cost of sales column. In the perpetual system, we will have a cost of sales column. The reason for this is in the perpetual system, for every time when you sell goods or goods are returned, you have to record an entry for the cost price of the goods and for the sales price. In the periodic system, you only do a single entry for the sales price. You don't record anything about the cost price during the financial year. If we look at the cash payments journal, all cash purchases will be recorded in the purchases column, because in the periodic system, you are not allowed to record anything in the inventory account during the year. The balance that's in the inventory account at the beginning of the year will go to your statement of income at the end of the year as your opening inventory. In the perpetual system, you will have a column for inventory, because every time when goods are bought or sold, an entry will be recorded in the inventory account to determine how much inventory is left over in the business. In the debtors journal, when you sell goods on credit, just as we had in the cash receipts journal, there will be no cost of sales column. So whether you sell the goods for cash or whether you sell the goods on credit, you don't record cost of sales in the periodic inventory system. In the perpetual inventory system, you will use a cost of sales column because you have to record the cost price of the goods sold. So whether you sell it for cash or you sell it on credit, you will record the cost of sales and you will record the sales price separately. In the creditors journal, when we buy goods, because we are not allowed to record anything in the inventory account, there will be a purchases column. So that means if we look at the cash payments journal, when we buy something for cash or when we buy something on credit, we will have a purchases column that will replace the inventory column, because we are not allowed to write in the inventory account. In the perpetual system, the inventory will be recorded in the inventory column because we want to transfer this information to the inventory account to determine how much is the value of inventory that's still available in the business. So for cash purchases or for credit purchases, you will record the entry in the inventory column. If we look at the debtors allowances journal, there will not be a cost of sales column. So when we sell goods for cash, whether we sell goods on credit and whether the debtors return goods, there will never be a cost of sales column, because we don't work with cost of sales and inventory in the periodic system during the financial year. In the perpetual system, you will have a cost of sales column, because when you sell goods for cash or you sell it on credit or the debtors return it, you have to record the effect of those entries on your cost of sales and inventory. If we look at the creditors allowances journal, all returns will be recorded in the creditors allowances column. So both methods will have a creditors allowances journal, but in the periodic system they have a creditors allowances column and they have a creditors allowances account. In the perpetual system, when goods are returned, we record it in the inventory column because we record purchases, sales of inventory, returns of inventory every time in the inventory account to determine how much inventory is left over in the business. In the perpetual system, you will have a creditor's allowances and a journal, but you will not have a creditor's allowances account. If we look at the general journal, all transactions that affect inventories that will be recorded in the purchases account. So if the entry does not fit into any of your previous journals, you have to record it in the general journal. So if the owner takes goods for its own use, it will be drawings and purchases. If the owner takes goods out of inventory to use as stationery in the business, it will be stationery and purchases. Or if they use some of the inventory in the business for a marketing project, then they will debit marketing, credit, purchases. In the perpetual system, the effect will be recorded in the inventory account because we want to show that the inventory decreased. So what did we learn today? In the periodic system, you don't use an inventory account. In the perpetual system, you use an inventory account. In the perpetual system, all transactions that will increase or decrease inventory, that means anything that will have an effect on your inventory in the business, will be recorded in the inventory account. In the periodic system, you don't use an inventory account at all during the financial year. You also don't use a cost of sales account during the year, where in the perpetual system you will use the cost of sales account every time when goods are sold for cash on credit or goods are returned by debtors. In the periodic system, they use a creditor's allowances account when they return goods to the creditors. In the perpetual system, they use the inventory account when goods are returned. Both methods have a creditor's allowances journal, but the ledger accounts for the periodic system will be creditor's allowances account that will actually reduce your purchases. And in the perpetual system, you will use your inventory account to show that the total amount of inventory in the business decreased. In the periodic system, you don't record an inventory deficit or any losses as a result of fire or burglary, damaged goods, whatever. Because the closing inventory will be less, it will be absorbed by the cost of sales, and automatically the cost of sales figure will go up as a result of the reduced inventory. In the perpetual system, you will record any inventory deficits or losses, whether it is because there's a write down to net realizable value, losses as a result fire of burglary, or losses of inventory that you don't know how the things disappeared. Any losses will be recorded in the perpetual inventory system.